So, good evening everyone, and welcome to this session on trading strategies. As we all know, the key to success as a trader is applying the 3 M's to every trade you place. And just to recap, the 3 M's are mind, which is trading psychology, money management, and the final M is method, which is what we're talking about today as in trading strategies. So the method of how you trade, how you approach the market, how you get in and out of the market is called trading strategies. So trading strategies are just basically how do you get into the market, how do you get out of the market. And I always remind traders that there are 1,000,001 ways to trade, there are 1,000,001 strategies. There are 1,000,001 ways to get into the market and 1,000,001 ways to get out of the market. No one method will give you 100% success rate. So if you remember the presentation on money management, remember that in money management, a 40% success rate is good enough to make you millions as a trader. But you're never going to get 100% success rate, and there's no strategy that's going to give you 100% success rate. So that's very important to always remember that regardless of the strategy, the software, the signals, the indicators you use, the trading pattern you use, whatever you do, you are not going to get 100% success rate. So again, that's why the 3 M's are important. So regardless of the strategy you apply, always remember good money management. You need to apply good money management to every strategy you place, and also good discipline, because that's your key to success, is having a strategy and being consistent with that strategy. And that's where trading psychology comes in. So you still need to apply good discipline and trading psychology, good money management to whatever strategy you place, because whatever strategy you use, you're going to have losses, and it's never going to be 100%. So that's just very important to remind you about that as we start discussing about trading strategies. Now, the markets can only trend 3 ways. So regardless of how complicated you want to make the financial markets look or sound, the markets really can either go up, down, or sideways. The markets can't go any other way apart from those 3 ways. So the markets can trend 3 ways. So one, it can go up. So the market starts to trend up, you're looking to buy. And when the market is uptrending, the market tends to make higher highs and higher lows when it's uptrending. And another term for market being uptrending is when people say the market is being bullish. So when the market is being bullish, it's going up, or it's uptrending, and that's an indication to buy. Now when the market is trending down, you're looking to sell. And when the market is downtrending, it's making lower lows and lower highs. And another term for that is we call the market being bearish. So when they say the market is being bearish, it means the market is falling or trending down, and it's making lower lows and lower highs, and you're looking to sell and profit from that. And the third is that the market could just be going sideways. So when the market is trending sideways, it's neither going up or down, so it's just going sideways, no pattern to it. And in that scenario, you want to keep out of the market. So it's quite straightforward. So market can either trend up, where you're looking to buy, trend down, you're looking to sell, it's trending sideways, you keep out of the market. So we'll start with the sideways trend. This is what a sideways trend looks like. The market just going flat, not going up or down. So that's just an example of a sideways trend. And when the market is trending sideways, you want to keep out of the market. More often than not, you don't realize the market is trending sideways or until it has trended sideways. So more often than not, you can only tell in hindsight that the market has been trending sideways. But there are certain conditions where the market tends to trend sideways. And obviously, if you can recognize these conditions where the market could trend sideways, then obviously you want to avoid trading in those conditions. One of the major conditions where the market has a high probability of trending sideways is when there's uncertainty in the market. So when there's uncertainty in the market tends to trend sideways. So whatever creates uncertainty in the markets, you need to be careful or avoid trading altogether. So there are certain things that cause uncertainty in the market on a regular basis. One is prior to major elections in the UK or USA. So prior to the Prime Minister elections in the UK or the presidential elections in America, about a week or two prior to these major elections, the markets tend to trend sideways. Another cause of the market to trend sideways due to uncertainty is prior to the last economic report of high importance for the day. So that's why it's very important for you to check the economic calendar prior to you trading that day, to check which reports of high importance are due out. So you want to avoid trading prior to that report being announced. Another major cause of markets trending sideways is when there are reduced volume of traders in the markets. So when there are reduced volume of traders in the market tends to trend sideways. So what causes reduced volume of traders in the market? Obviously, one is public holidays in the UK and USA. So when there's a national holiday in the UK or a national holiday in the USA, the markets tend to trend sideways. So again, it's very important to be aware of the national holidays in the UK and USA and avoid trading on those days because of the reduced volume of traders. And also between 9 p.m. GMT plus 1 and midnight GMT plus 1, between 9 p.m. GMT plus 1 and midnight GMT plus 1, there are reduced volume of traders in the market because at that time, all the stock exchanges around the world are closed, which causes reduced volume of traders in the market, and the market tends to trend sideways between those times. And the final one is the day after huge moves in the market. So be careful trading the day after a huge move in the market. Very, very important. Okay? So, that's why you hear stories of traders who are profitable one day and then the next day they lose all their money. And the reason why that happens is because obviously they might have had a very profitable day and they think it's going to happen the next day, and the market starts trending sideways on that day and then they lose money. So you have to be very careful trading the day after a huge move in that market. Very important. So this is just another picture showing you what tends to happen prior to an economic news being released. So you can see to the left of the screen, that the market was trending sideways while waiting for the report to come out. So this is left of the screen here. The market was trending sideways prior to the report coming out, and then once the report was released, you can see how the market reacted and became very, very active following the release of the report. So that's what you want to do. You want to avoid trading prior to the report, and then once the report is released, you can try and profit from the market's reaction to the report. Okay? So trading strategy is just you having a clear written down trading plan of how you want to trade and the steps you're going to take to approach the market. You also need to decide which technical indicator you're going to use, and we've covered that when we talked about technical analysis. So you have to have a clear plan, a step-by-step plan of how you're going to approach the market, which indicators you're going to use, and most importantly, you need to define clearly what your entry criteria is into the market and clearly what your exit criteria will be. So your plan is to state how you're going to get into the market, so that what are your criteria for pulling the trigger and entering the market, and most importantly, what your criteria are for exiting the market to either take a profit or cut your losses. And most importantly, you need to stick to that plan, and you need to be consistent. And remember, no plan is going to give you 100% success rate. So the key to success is you being consistent with your plan. So I'm just going to quickly show you some examples of some entry points. Again, like I said, there's 1,000,001 ways to enter the market, and these are just a few entry points that I use. And the most common one I use is the pivot point strategy. So it's the pivot point strategy I use to enter the market, and I'll be covering the pivot point strategy in the next presentation. We'll be discussing pivot points in detail. So that's one strategy I use to enter the market. Another strategy I use to enter the market is the market support and resistance strategy, where I use the market support. So if the market breaks the market support, I sell. If it breaks the market resistance, I buy. So that's another entry point I tend to use. Another entry point to use is the moving average. I can also use the moving average as an entry point into the market. And here are some day trading exit points I use. So exit points I use in the day trading. Commonly, I use the 1 to 3 risk to reward ratio as my exit strategy. I usually use about 20 pips stop loss to exit the market to cut my losses, and a 60 pips profit target to take my profit, which fits the 1 to 3 risk to reward ratio. So the 1 to 3 risk reward ratio is a very common exit strategy I use to exit the market when I'm day trading. You can also use the pivot points to exit the market as a day trader. You can use the moving average to exit the market. And you can use highs and lows of the trend market. Okay, so that's in a nutshell is trading strategies. Like I said at the beginning, this should be applied in conjunction with the 3 M's. Making sure you use good mindset, trading psychology, make sure you're disciplined, apply good money management, and know what you're risking with every trade. And then finally, with the trading strategy, which is the method, the 3rd M is to have a plan of how you're going to approach the market, when to trade, when not to trade, things to look out for, when to enter the market, when to exit the market. Okay, so that's the presentation on trading strategies. If you have any questions, do click the hand button or send your questions through the question box.